Are you one of the many investors that end up holding shares in just one individual company because you were given them as share options? You may be restricted from selling them by the conditions of your employment contract, but if you're not, you may want to consider whether it is in your best interests to hold on to them. Familiarity with these shares or a successful track record while holding them may be discouraging you from diversifying. Unfortunately, this can lead to one of the most well-known cautionary tales in investing: tragic declines in wealth from losses in a single company share. But why is this the case? Dimensional fund advisors analyzed data from the US stock market between 1927 and 2020. That's almost 100 years to understand the level of survivorship of individual shares. It's normal and a sign of economic health to have a level of stock turnover in the market as companies default or are taken over by others. The average survivorship statistics over rolling periods imply a little over 1 in 5 US stocks available in the market at a given time delist within 5 years. The survival rate goes down over longer periods, with just under half of the stocks on average still trading 20 years later. Now, not all delists are bad for investors. As I mentioned before, companies merge or get bought out by other companies, and in these situations, as a shareholder, you would be compensated. However, bad delists, including the companies that delist due to deteriorating financial conditions. Over 20 years, about 18% of individual stocks on average become bad delists. So that's almost 1 in 5 chance that your individual shares will default over a 20-year period. The second factor to consider is whether your individual shares are outperforming the market as a whole, or the wider market. Are you getting a better return by staying invested in just one individual company than if you would have invested in the whole of the stock market? Data suggests that almost 35% of individual companies survived and outperformed the US stock market over a rolling 5-year period, and this figure drops to 21% over a rolling 20-year period. So if you're investing for the long term, you've got a 1 in 5 chance that your shares will outperform the market. So if holding shares in just one company isn't the best option, what is? Well, in my opinion, a well-diversified portfolio of shares has been shown to help investors reliably capture market returns, limit individual stock risk, and improve the ability to tilt towards segments of the market with higher expected returns. If you do move from a concentrated portfolio of individual company shares to a broadly diversified one, you do need to be mindful of your liability for capital gains tax. Every individual's situation is unique, but it's worth getting advice from an independent advisor, as the long-term benefits of diversification may outweigh the short-term costs associated with liquidating your concentrated portfolio. To learn more about the benefits of globally diversified investment portfolio, take a look at my video on that very topic. Thank you as always for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help people live successful lives. That often involves understanding your money. I host a podcast called the Retirement Cafe Podcast. You might like to tune into that. Check out the description below, or of course you can also sign up for my weekly newsletter, which is packed with inspiration and tips for a successful retirement. I hope you've enjoyed this video. If you have, please press the like button to help more people like you find my channel, and of course subscribe so you never miss an episode. For now, I'm Justin King, helping you live your best life.